There are financial lists with your name on them right now. You have never seen them. You were never told about them, but they decide how much freedom you actually have inside the banking system. Here is the threat. Your money can work perfectly for years. Then one day it stops. A transfer fails, a payment is blocked, an account is placed under review, and no one explains why. Here's the proof. Every day people wake up to frozen accounts, declined transactions, delayed withdrawals, and banks that respond with the same phrase, "This was a system decision." And here's the promise. By the end of this video, you will understand how these hidden lists are built, how people get placed on them without knowing it, and why once the system flags you, escaping it becomes extremely difficult. Now let us slow this down. Most people believe money is simple. You earn it, you deposit it, you spend it, the bank stores it, the system processes it. End of story. That belief is outdated. Modern banking is not built on trust. It is built on probability, and probability requires classification. The moment you open a bank account, the system begins measuring you, not judging you morally, measuring you statistically. Your spending patterns, your login behavior, your device changes, your travel, your transaction sizes, your merchant categories, your frequency, your timing, all of it feeds models. Over time, those models build something more powerful than a credit score. They build a behavioral identity, and that identity determines how you're treated, not always visibly. At first, it is subtle. A verification request here, a delay there, a flagged transaction that resolves after a few minutes. It feels random. It is not random. You are being categorized. Now here is where most people misunderstand the system. Your bank is not the only observer. Behind your bank are payment processors, fraud detection engines, compliance databases, and interbank monitoring networks. These systems share signals. They compare patterns. They exchange risk markers. You think you have one relationship with one bank. In reality, you are interacting with an ecosystem that remembers. Imagine two people with identical credit scores and identical balances. One lives quietly, same city, same stores, same routine, predictable spending, no unusual transfers. The other travels often, uses different devices, experiments with online platforms, sends money internationally, buys crypto, receives refunds, moves between accounts. Both are legal, both are normal, both are responsible. But to a machine, they are not equal. One is predictable, the other is complex. And complexity increases risk models. Risk models increase monitoring. Monitoring increases friction. This is how it begins. No one calls you, no one sends a warning. You simply move from one behavioral tier to another. You will not see the list, but you will feel the consequences. Let me ask you something. Have you ever logged into your account from a different country and received a security challenge? Have you ever had a payment decline that seemed completely ordinary? Have you ever waited longer than usual for a transfer to clear? Those moments are small glimpses into a larger structure. The structure is not looking for criminals. It is looking for anomalies. And anomaly does not mean illegal. It means statistically unusual. Financial systems do not operate on emotion. They operate on probability curves. If your behavior deviates from expected patterns, the system adjusts how it treats you. Maybe your transaction triggers manual review. Maybe your account enters a monitoring tier. Maybe your name gets attached to an internal watch category. You will never see that category, but it exists. Banks maintain internal risk lists. Payment networks maintain behavioral databases. Fraud engines track anomaly histories. Even resolved issues remain in metadata because past irregularities help predict future risk. So even if a flag was cleared, the memory of that flag may still influence your profile. That is how machine compliance works. And here is the uncomfortable truth. The system does not reward independence. It rewards predictability. Predictable users are easy to model, easy to approve, easy to automate. Independent users create noise. Noise requires scrutiny. Scrutiny creates friction. Friction limits freedom. Over time, this changes how people behave. They become cautious. They avoid unusual activity. They stay inside safe patterns. Not because they want to, because they learn that deviation has consequences. This is the invisible pressure of the list. It does not scream. It does not announce itself. It simply adjusts how easily your money moves, and most people never connect the dots. Most people imagine that these lists are created by one organization sitting in one building, manually watching accounts and deciding who looks risky. That is not how it works. There is no single control room, no master operator, no person watching your screen. What exists instead is a layered network of automated systems that constantly exchange information. Your bank is only one layer. Above it are card networks, payment processors, fraud engines, compliance platforms, identity verification services, and regulatory reporting systems. Each of them runs its own models. Each of them keeps its own internal records. Each of them evaluates you from a different angle, and all of them talk to each other. When you swipe your card, the transaction does not go straight from you to the store. It passes through several systems in seconds. Each system checks something: location, device, history, merchant type, amount, timing, pattern similarity, prior flags. Most of the time, you pass. Sometimes you do not. And when you do not, that information does not disappear. It is stored. It becomes part of your behavioral file. Over time, those files grow. They include where you usually shop, how often you travel, how stable your income looks, how frequently you move money, how often you change devices, how you respond to security checks, how you handle disputes, how you interact with platforms. These details are not kept in one place. They are distributed across systems. One company might know your devices, another tracks your spending rhythm, another monitors transfers, another evaluates account relationships, another watches login behavior. Each piece seems harmless. Together, they form a profile. Now imagine what happens when one of those systems becomes uncomfortable with something you did. Maybe you sent money to someone new. Maybe you bought something in a category you never touched before. Maybe you logged in from a new country. Maybe your spending suddenly increased. Maybe your income source changed. Maybe you used a privacy tool. Maybe you opened multiple accounts. None of these are crimes, but they are signals. Signals feed models. Models update risk scores. Risk scores influence permissions. Once that happens, your experience changes. Not dramatically at first, quietly. A transfer that used to take seconds now takes hours. A withdrawal that was instant now waits for review. A payment that always worked now fails once. Support asks more questions. Verification requests become frequent. You feel friction. But you still think it is random. It is not. Behind the scenes, you have entered a different category. Let us talk about sharing. Banks and payment systems do not operate in isolation. They participate in shared monitoring networks. These networks exist to reduce fraud and regulatory risk. If one institution detects unusual activity, it can send alerts through these networks. Other institutions receive those signals. They adjust their own models. They increase scrutiny, not because they know what happened, because another system was concerned. This is how reputations spread quietly. You never see the message. You never see the alert. You only feel the result. Imagine closing an account and opening a new one somewhere else, thinking you are starting fresh. In many cases, you're not. Your identifiers follow you, your devices, your behavior patterns, your transaction history, your identity records, your verification history. Systems recognize similarities. They reconnect the profile, so the classification continues. Now, let us talk about automation. Humans rarely review most accounts. It would be too slow, too expensive, too inconsistent. So software does it. Software evaluates. Software flags. Software restricts. Humans step in only after the system acts, and often they are not allowed to reverse it. Support agents follow procedures. Compliance teams follow protocols. Managers follow regulatory rules. If the system marks something as high risk, the safest decision is to block. Not to investigate, not to empathize, not to negotiate, to block. Because blocking protects the institution. That is the incentive structure. And incentive structures shape behavior. Let me give you a real scenario. A small business owner sells online. 1 month, sales spike because of a viral post. Revenue triples, payments flow in, refunds increase slightly because volume increased. To the owner, this is success. To risk systems, it looks like a sudden pattern change. Spike in volume, increase in disputes, new customer base, international traffic. That combination triggers alerts. The account enters review, funds are held, payouts are delayed, bills still arrive, rent is due, suppliers want payment, support says wait. The system is checking. No one explains, no one guarantees. The owner feels powerless, nothing illegal happened. But the list was activated. Here's another example. A freelancer works remotely and travels often. Different countries, different networks, different devices. To humans, this is modern work. To systems, it is inconsistent access. Inconsistent access equals elevated risk. Elevated risk equals restrictions. So more challenges appear, more verifications, more temporary locks, more reviews, until one day something gets stuck. And unsticking it takes weeks. Now think about this. How many of your financial decisions are made by people? Almost none. They are made by layers of software that were designed to minimize institutional risk, not to maximize your freedom. That is the foundation of the list. It is not personal. It is structural. And structural systems do not care about individual stories. They care about averages, trends, probabilities, outliers. If you become an outlier, attention follows. And attention in financial systems rarely feels positive. Once you are categorized inside these systems, something subtle begins to change. You still have your account, you still have your balance, you still have your cards, but your experience is no longer the same. The system does not shut you down immediately. That would be obvious. Instead, it adjusts how much friction you feel. Transfers that used to move instantly now pause. Large payments trigger verification. International transactions require extra review. Deposits take longer to clear. Withdrawals wait for internal approval. At first, you assume it is random, then it becomes a pattern. What you are experiencing is not punishment, it is containment. Financial systems are designed to contain uncertainty. If your profile indicates elevated risk, even slightly, your account can move into a higher monitoring tier. Higher tier means more surveillance, more automated triggers, lower thresholds for restriction, less tolerance for deviation. And here's the problem. You are never told which tier you are in. There is no dashboard showing your internal classification. There is no notification saying your behavioral trust rating decreased. You only see symptoms, and symptoms feel unpredictable. Now let us talk about appeals. Most people assume that if something goes wrong, they can simply call and explain. That works in human systems. It does not work well in automated systems. When a restriction happens, it is usually the result of multiple signals stacking over time. By the time you notice a problem, the model has already built its case. Support representatives do not have authority to override statistical risk engines. Compliance departments are not rewarded for taking chances. If a system marks something as potentially problematic, the safest institutional decision is to maintain the restriction. From the bank's perspective, releasing funds too early carries more risk than holding them too long. So you wait, sometimes days, sometimes weeks. In extreme cases, months, and during that time your life does not pause. Bills do not pause. Rent does not pause. Obligations do not pause. You feel pressure. This is where the invisible power of the list becomes visible. It does not need to accuse you. It only needs to delay you. Delay creates vulnerability. Vulnerability creates compliance. Over time, people learn what behavior increases friction. They learn that certain transactions cause reviews. They learn that certain patterns trigger holds. They adjust, not because someone told them to, because the system trained them. This is how financial control evolves in modern societies, not through loud bans, through quiet inconvenience. You start thinking twice before making certain payments. You avoid categories that might trigger flags. You hesitate before moving money internationally. You simplify your financial life. Predictability becomes safety. Safety becomes the goal. And gradually, independence shrinks. Now consider something deeper. Risk systems are not static. They evolve. They learn from patterns across millions of users. If a particular behavior correlates with higher fraud rates statistically, even if most people performing that behavior are innocent, the model adjusts. Thresholds tighten. Sensitivity increases. What was normal yesterday becomes suspicious tomorrow. You never receive a memo explaining this shift. You only experience the new boundaries. And here is where it becomes difficult to escape. If you decide to leave one bank and open another, you assume you are starting over. But your identity data follows you, your verification history, your transaction metadata, your device fingerprints, your linked accounts. Systems recognize patterns across institutions. So even if the new bank does not know your past directly, shared risk networks may. The classification does not disappear, it migrates. Now imagine stacking years of small irregularities. Nothing dramatic, just occasional flags, occasional reviews, occasional disputes, occasional delays. Individually, they mean little. Collectively, they form a long-term profile. And long-term profiles are powerful because they influence future decisions automatically. You might not be blocked, but you might always be watched more closely. You might not be denied outright, but you might always experience slightly more friction than someone else. This is what most people never realize. Freedom inside financial systems is not binary. It is tiered. Some users move with almost no resistance. Others constantly encounter small barriers. Those barriers are not random. They are the result of classification. Now let us look at the psychological effect. When people experience unpredictable friction in essential systems, they become cautious. Caution is rational, but chronic caution changes behavior. You become less experimental, less willing to take risks, less willing to explore financial independence. You stay inside safe boundaries, not because you fear the law, because you fear interruption. That fear is subtle, but it is powerful. It shapes entire populations. Over time, financial systems reward those who are stable, repetitive, and easy to model. They penalize those who are complex, mobile, or unconventional, not intentionally, structurally, and structural incentives are stronger than personal intent. This is why understanding the list matters. It is not about paranoia. It is about awareness. When you understand that invisible classification exists, you stop assuming that access is permanent. You start recognizing that your financial identity is dynamic. You begin thinking long-term. Because here is the truth. The system does not need to eliminate you. It only needs to limit you enough to keep you compliant. And limitation often arrives quietly, one delay at a time. When you step back and look at the system as a whole, something becomes very clear. The list is not a temporary solution. It is the foundation of modern financial control. Every year, systems become faster. Every year, automation becomes deeper. Every year, more decisions are removed from human hands. What used to require investigation now requires only pattern recognition. What used to require judgment now requires only probability. This makes the system efficient. It also makes it unforgiving. Artificial intelligence is accelerating this process. Models now analyze millions of behaviors in real time. They predict risk before anything happens. They assign threat levels to people who have done nothing wrong. They calculate future probability based on past deviation. In other words, the system no longer reacts. It anticipates. And anticipation changes everything. In the past, you were restricted after something happened. In the future, you will be restricted because something might happen. That is a profound shift. It means freedom becomes provisional. It means access becomes conditional. It means approval becomes temporary. Now consider what happens when this logic spreads. Banks use it. Payment apps use it. Employers use it. Insurance companies use it. Landlords use it. Governments use it. Once reputation scoring becomes normalized, it moves into every domain of life. Your financial profile merges with your employment profile. Your employment profile merges with your digital behavior. Your digital behavior merges with your identity records. Everything connects. Everything informs everything else. At that point, the list is no longer just financial. It becomes social. And social classification has always been one of the most powerful tools in history, not because it punishes directly, because it shapes opportunity. Opportunities appear for some, they disappear for others, quietly, without announcement, without explanation, without appeal. This is why most people will never understand what is happening. They will think they lost access because of bad luck, because of a technical issue, because of a temporary error. They will not see the structure. They will not see the network. They will not see the incentives. And because they do not see it, they will not prepare. Preparation does not mean rejecting technology. It means not depending on any single system completely. It means building redundancy. It means diversifying income. It means maintaining skills that are not platform dependent. It means keeping options. It means valuing flexibility. It means understanding where your vulnerabilities are. People who survive system shifts are not the strongest. They are the most adaptable. Throughout history, every major economic transition rewarded those who anticipated change. Those who waited were forced to react. Reaction is always more expensive than preparation. The list will not disappear. It will expand. It will become more sophisticated. It will become more integrated. And it will become harder to notice. Because the more advanced it becomes, the smoother it feels. Restrictions will look like convenience. Monitoring will look like safety. Compliance will look like stability. Most people will accept it, not because they agree, because it feels normal. And normalization is how power becomes invisible. Now let me say something important. This channel is not about fear. It is about clarity. Understanding systems gives you leverage. Leverage gives you options. Options give you resilience. Resilience gives you freedom, even in controlled environments. If you're watching this, it means you care about understanding how money, power, and technology actually interact. That already puts you ahead of most people. But awareness only matters if you continue learning. The world is changing fast. Financial systems are becoming more complex. Control is becoming more subtle. And ignorance is becoming more expensive. In the next video, we are going to talk about the second score, the invisible banking reputation that determines how much freedom you really have, because the list is only the first layer. What comes next is even more powerful. If you want to understand this world instead of being surprised by it, make sure you subscribe, not for entertainment, for survival, for clarity, for long-term thinking. Because in the future, that is being built right now, knowledge will matter more than money.